Hey there, welcome to the first episode of 7 Pillars of Property Data. I'm Kuldeep from Prime Pace Properties. And if you have been thinking about getting into property or maybe building out your portfolio, this is where it all starts with strategy. Not on realestate.com, not with suburb stats. It starts with a really honest conversation. Why are you investing? What do you actually want out of this journey? You see, before we even look at properties, we have got to talk strategy. Because if you don't know where you are going, you can't pick the right route, and you definitely can't tell if you are making progress. Think of strategy like building a GPS before starting a road trip. You need to know your destination, your budget, the terrain, and how far you are willing to go. These nine strategic factors will help answer questions like what kind of returns are you aiming for? How much risk can you handle? Do you have capacity to grow a portfolio? What happens if interest rates go up? Let's go through them one by one. Very first on the list is choosing a pathway. Are you looking to build long-term wealth through rental income and capital growth? Or do you prefer buying, renovating, and reselling for short-term gains? Your pathway will define the kind of properties to look for, as buy and hold requires stable, growth oriented suburbs with strong rental demand, whereas flip strategies work best in fast moving markets with cosmetic value add potential. Well, on the scale of 1 to 5, I would rate it towards highly important as this defines your time horizon, renovation risk, tax implications, and property type. And depending on your pathway, you can get related information from various data sources. Like CoreLogic, Domain can provide information related to property sales history. BMT, Archi Center Australia can give you insights on reno cost guides. And refer to ATO for tax implications. And remember, flipping can trigger full income tax, not just CGT. Also, rising interest rates and slowing markets can make flips riskier. Next factor on the list is related to cash flow. Do you want your property to generate income from day one? Or are you comfortable topping it up each month in exchange for long term growth and tax deductions? Or maybe you're looking for a balanced approach. Cash flow properties tend to be in regional or high yield metro suburbs. Negatively geared properties are often in blue chip areas with strong long term capital growth. On criticality rating, I will rate it as crucial as it affects your lifestyle, borrowing capacity, and portfolio scalability. And you can use the on screen data sources to evaluate cash flow on prospected properties. Positive cash flow improves loan serviceability and can help fund your next investment sooner. Moving on to next factor in strategy pillar, that is LVR or loan to value ratio. This is the percentage of property's value that you are borrowing. A lower LVR usually means lower risk and better loan terms. Lenders often reward LVRs with lower interest rates. On one side, higher LVR may trigger LMI, eating into your equity. On the other side, lower LVR could also mean that you would need significant more cash to settle. Based on your situation and individual circumstances, you need to decide what works best for you. On the criticality meter, it's non negotiable, as this directly impacts your ability to borrow, refinance, and manage overall risk. You can use on screen resources to calculate LMI information. LVR also determines how quickly you can scale your portfolio. Keeping it balanced as per your cash flow gives you control over managing risk and more flexibility in acquiring more assets. Next factor is DSR, also known as debt service ratio. This measures whether you can comfortably repay the loan. Lenders assess your income, debts, and expenses, and they stress test for rate rises. Increased interest rates and tightened lending rules can affect how much you are allowed to borrow, even if your income is strong. As for how important it is, I would say it is fundamental. This is the gatekeeper to your borrowing power. Instead of data sources or online tools, I would recommend to work with an experienced mortgage broker to evaluate your situation. Reducing personal debt can instantly boost your borrowing power, even more than saving a deposit. Remember, you don't need multiple credit cards as it eats into your borrowing power. One is more than enough. Now, on to factor number 5. If you already own a property, you might be able to access built up equity instead of saving for a deposit again. Equity allows you to move faster and potentially avoid costly LMI or unnecessary loans. It is the key for portfolio growth, especially if you plan to buy more than one property. You can use following data sources to evaluate your property: online bank valuation tools, CoreLogic RP data, Price Finder Suburb reports. You can often access equity through a top up loan or refinance without touching your existing cash reserves. And if you have done a reasonable renovation, always opt for a full property evaluation instead of desktop or curbside evaluation, as you got better chance for unlocking more equity. Moving on to exit strategy. How will you eventually exit the investment? Sell, refinance, develop, or hold and pass on? Exit potential depends on the asset class, market liquidity, and local demand. It is quite critical as you don't always control timing, so having a flexible exit plan matters. You can use on screen data sources for research. Avoid high risk assets with limited resale demand, like student apartments or oversupplied high rises. Coming next on the list is tax structure. This is about who owns the property: you, a company, a trust, or an SMSF, and how that affects your tax, liability, and borrowing. Tax structure affects everything from negative gearing benefits to land tax thresholds and asset protection. And it is extremely critical if you're planning to build a multi property portfolio. As data sources or advisors, you can use ADO guidelines, your accountant, or a specialist property tax advisor. Remember, a poorly chosen structure can cost more to undo than to set up right. Always get advice upfront. At number 8, we have insurance cost and related risk. This includes the cost of insuring your property and whether the area is high risk for flood, fire, crime, or any other event. High risk properties may have higher premiums, lower desirability, and valuation issues. On the rating of 1 to 5, I would say it is quite significant as it can affect your returns. It is often ignored until it's too late, but it can affect your net cash flow and risk profile. You can use the on screen resources to get insights on the risk areas. And the bonus tip for this is always get an insurance before signing a contract, especially if you're targeting regional or coastal zones. Last but not least, buffer strategy. Your emergency fund, the money you set aside in case something unexpected happens. Having a buffer helps you hold through downturns, avoid stress, and prevent forced sales. It is important for peace of mind and smart long term investing. You can use budgeting apps like Frollo, Pocketbook, or Money Smart Budget Planner. And we also have our own portfolio management tool to assist with risk assessment and buffer calculation. A solid buffer covers 3 to 6 months of your loan repayments and expenses. It is your personal insurance policy. Well, that's the strategy layer, the lens through which every future property decision should be made. And without it, it's like throwing darts in the dark. You might get lucky, but chances are you will miss your target. To make this easier, I have created an investment strategy checklist that you can download and fill out. Link is in the description. Whether you are a DIY investor or thinking of working with us, it will help clarify your direction. And if you are feeling unsure about your numbers or want to pressure test your plan, or you would like support building your strategy, reach out anytime. No pressure, just guidance and a friendly chat to say if we are a good fit. Thanks for watching, and I will see you in episode 2, where we will zoom out and look at the economic signals every investor should understand. And last but not least, remember to like and subscribe and share it with anyone who is interested in real estate investing.